Good afternoon if you're watching from North America. Good evening if you're here with us in Israel. This is Josh Sussman from Nefesh B'Nefesh's marketing and events team. We thank you for joining us. We are honored today to have with us both Eli Cole, who's a partner at Expat Tax Services, and Boaz Feinberg, who is the partner and head of tax practice at Tadmor Levy in Tel Aviv. Eli and Boaz will be leading these conversations for this session. Please direct all your questions to the Q&A section, not to the chat. The Q&A is being monitored both by us and associates of Boaz from his firm, who will be answering your questions as we go. We will also be taking some live questions throughout that Eli will be moderating. So please do keep your questions in the Q&A. This session is being recorded, and we will send it out, the recording, along with the PowerPoint presentation that Boaz is going through, and contact information within the next 24 to 48 hours to everybody who registered. We do have over 450 people registered, so the number of questions that we're going to be able to take live speaking over the course of the next a little bit less than an hour is going to be limited, because we're going to be overwhelmed with questions if past experience tells us anything. With that, Eli, take us away.
Thank you, Josh. My name is Eli Cole from partner at Expat Tax Services. My firm specializes in U.S. tax reporting, mainly for Olim Chadashim, or individuals living in Israel. I've been doing seminars with Nefesh B'Nefesh for a bunch of years. We've moved into Zoom the last 6 months or so. Generally speaking, the talks I give focus really on U.S. tax, as people want to understand the U.S. tax effects when they make Aliyah and they're going to be working from Israel for their U.S. company, for a different company. How's the U.S. going to tax their pension, their Social Security, all the U.S. tax effects. That's usually my focus, and I talk a little bit about Israel. This seminar is actually going to be a complete opposite, and actually I'm going to mostly listen and answer Q&A as Boaz takes the lead, as I regularly pass people over to Boaz, who will introduce himself, but he's an expert with the Israeli tax and Israeli legal issues, as a lot of times people want to understand not just how the U.S. is taxing you, but how's Israel going to be taxing, what the Israel tax situation going to be. So my contact information is here. I'll be answering Q&A specifically about U.S. tax, and then Boaz has a couple colleagues here that can answer more of the Israeli questions, and then both myself and Boaz have our contact information passed along, and you can reach out to us individually if you have any specific questions or anything we didn't cover. And with that, I'm going to hand it over to Boaz.
Thank you very much, Eli, and hello everybody, and thank you for participating. My name is Boaz Feinberg. I'm the head of the tax practice at Tadmor Levy offices, and I've been practicing tax for the last 20 years. Eighth generation Jerusalemite. That's from my mom's side. From my dad's side, I'm fourth generation. And we're now discussing the possibility of people who are interested in coming here and immigrating into Israel, or have children who are planning to do so. And we're going to discuss tax. We got a lot to cover. So we'll begin by reading the agenda. We'll start with a short introduction to the legal infrastructure and definitions. General tax benefits for Olim, passive income, what happens when you receive passive income when you're in Israel for the first 10 years, capital gains, business income. We'll also discuss real estate taxation, specifically purchase tax for new immigrants. And we'll end up with trusts, which is an issue that I know that many of you are looking for answers. And things are not as easy as you know, of course, in the United States, trusts and estates is not an easy subject. We will try and do a little bit of seder in this issue as well. So moving on, beginning with the legal infrastructure, two tax laws or major tax laws that you should be familiar with. One would be the income tax ordinance from 1961, which deals with most tax issues in Israel: income tax, corporate trusts, passive and capital gain. And the land tax law, which is uniquely addressing the issues of purchasing and selling real estate in Israel. So for instance, if it's real estate outside of Israel, it will be dealt with in the income tax ordinance. And if it's real estate in Israel, it will be dealt most of the times with the land at the land tax law. A little bit of definition, just so we'll be on the same page. Aliyah means immigrating to Israel. Anoleh is a new immigrant, an Israeli resident for the first time. I would mention that the terminology of oleh, when it comes to purchase tax and real estate, may be a bit different than being actually immigrating for the first time. And the benefits that an oleh chadash can receive on purchase tax in accordance to the land tax law is also with regard to those who were in Israel in the past, for instance, for a short period of time, volunteering for the army or being here on school for a very short period of time. They can also be considered olim in the eyes of the land tax law. And an Israeli resident, this of course is a legal term. In Israel, an individual whose center of life is held in Israel is an Israeli resident for tax. We have also presumptions of days, which are disputable. They may be disputable by both the taxpayer and the tax authorities, which basically speaking talks about 183 days a tax year. So if you are in Israel for longer than 183 days, you are presumed to be an Israeli tax resident. And again, this is a presumption that may be disputed. The coronavirus, for instance, the pandemic brought a lot of people to stay in Israel for longer than they anticipated, and this issue has arose. So the question is whether the fact that you spent more than 183 days in Israel, are you still considered an Israeli resident for tax purposes, is something that can be disputable and debatable. Although the Israeli tax authorities are looking to change the law and perhaps make the days test more determinable. So that was the legal infrastructure and definitions. Now we'll discuss in general the tax benefits for olim. So naturally, anyone who looked into Aliyah and looking into immigrating to Israel probably knows this. The 10-year tax holiday, we'll discuss more at length on passive and business income. Just to be clear about this, the tax exemption as it is today relates to two. One is the tax exemption, and the other is exemption from reporting or filing tax returns with regard to your foreign source income. This as well, the exemption of reporting is something that the Israeli tax authorities have for quite a long time are looking to repeal. And I have to say that the opposition in that issue is not strong. And it's just a matter of time, in my estimation, that they will repeal this and the reporting exemption will be repealed. More of general special tax exemptions for olim or tax benefits. One is with regard to the optional adjustment year, which means that if you are not still sure that you're making aliyah and you want to feel the water, so to speak, or feel the sand in Israel, so to speak, you may come to Israel and elect for the first year you are in Israel to be considered a foreign resident for tax purposes. You will have to file a specific request before that year begins, immediately when you arrive to Israel. And also, if you decide to stay after that 1 year, that year would be considered as if you are an Israeli resident and not a foreign resident. Another thing that you probably most are aware of is the 3.5 years of entitlement for special tax credits and a duty-free on import and purchase of a vehicle. Passive income. Israeli source passive income is taxable during the holiday period, and anything that is outside of Israel, which is passive income, would be exempt for the first 10 years of your arrival to Israel. So if we have passive income, we will address a few of those. If they were generated in Israel, for instance, if you own shares in an Israeli company and you receive dividends, you would pay between 25 to 30%. I would, from here on going forward, I'll just mention that all the rates are exclusive of the 3% surtax that are on an annual taxable income exceeding 651,000 shekels. But if it's lower than that, then the rates that I'm stating here apply. Individuals means any regular shareholder of the company, an individual. However, if you are a substantial shareholder, which means that you own either 10% in a company, or if you are entitled to nominate a board member, then you would pay an additional 5%. Tax rate on interest is divided into three. You have 25% to regular individuals, marginal tax rate, which can go all the way up to 50%, 50, including the surtax. So it's 47% plus the 3% surtax. You may find yourself paying marginal tax rate on interest payments you receive in Israel. And if it's special interest that is not linked to CPI or to linkage differentials, you may find yourself paying only 15%. Tax rate on rental income in Israel, you may have up to 5,000 shekels, an exemption on rental. 10%, this is an election you can make if it's indeed a passive income and not a business income. You may elect to pay 10% on the gross revenue of rental income in Israel. And if it's business related, then you would pay the marginal tax rate, which again can exceed up to 50% on the highest bracket. With regard to pension, and this is something that I know that many US immigrants are aware of and familiar with, the Israeli tax authorities the ordinance allows for the same tax that you would have paid if you would have remained in your country of origin. So for instance, and this is something perhaps that Ellie can get into as well, if you have an IRA, which you yourself are entitled to. We're not discussing those who received an IRA as an inheritance, which is a different issue. And I know that seeing the pre-questions that some of you have sent, this is a question that I know that is interesting. So with regard to an IRA that you yourself are entitled to, you've been working and employed in the United States and you invested that money in an IRA, the same tax that you would have paid if you would have remained a citizen, a resident of the United States, would be the same tax rate you pay in Israel. This will not apply if the IRA is inherited, because then the treatment is different. It's usually treated as a PFIC or as a closed circuit fund that should be taxed on the level of the fund itself. So for instance, if you have an IRA that during the year has invested in security and bonds, that income would be taxed on your individual level in Israel, as opposed to the United States, when usually the tax would be only upon the distribution of the fund. So that is with regard to an IRA that was inherited, as opposed to an IRA that you yourself invested the money from your employment. And Ellie, if you have anything else to add to this issue before we continue.
Yeah, just I guess I mentioned that, as you said, the inherited IRAs are kind of a separate beast, but aside for those, is the standard IRAs, assuming it's not inherited, kind of the bottom line is no incremental tax. So as Boaz said, Israel sets the tax rate based on what the US rate would be. So if the US ultimately asked this question already, we'll always ask the question, what about a Roth IRA? Or Roth IRA is zero tax in the US, so it'll be zero tax in Israel. Similarly, if you have, we talk mainly about US, but people that ask me, there's a fair amount of Canadians here, I understand. Same to the Canadian pension. If Canada has, if you have a specific Canadian pension, which is tax-free in Canada, Israel will give you that same rate. Or if Canada has a specific pension at a specific rate, Israel will match that. So there's no penalty. There's no additional tax you're going to have to pay on your IRA, on your pension, on any of that income. Additionally, I just want to point out this is U.S. tax specific, but it's really relevant to a lot of people. Social Security benefits is a unique thing that we have, given that U.S. Social Security benefits are actually tax-free both to U.S. and Israel. That's something special that the U.S.-Israel tax treaty gives you, where the United States says if you're an Israeli tax resident, we're not going to tax you anymore on your Social Security benefits, and Israel recognizes that as well. They also don't tax they don't tax at all on your Social Security benefits.
Right.
Boss?
Just to be clear, this specific exemption or benefit applies not only to the first 10 years, but for the entire time you spent in Israel ever since you immigrated. All right, so that was with regard to passive income. Capital gains. Capital gains, 10-year tax holiday on capital gains on assets located abroad. You should note that it is extended to assets that are located abroad that were acquired while you already became an Israeli resident. So that means that even during those 10 years, you purchased assets outside of Israel. Those, if you sell them before the elapse of the 10 years, you would not pay capital gain tax upon them. Not only that, but at the end of the holiday period, the capital gain tax is calculated on a linear basis. So that means, for instance, we brought here an example just to demonstrate. So suppose a person immigrated to Israel in 2010, purchased an asset in 2010 and immigrated to Israel in 2015. The end of the tax holiday period is in 2025, 10 years after he immigrated, and 5 years later, he sells that asset. Which part of the gain would be taxable? It's linear, meaning the 0.25 out of the total gain that was derived on that asset. Tax rates on capital gains in Israel, if you purchase assets in Israel, or after the 10 years have elapsed, it will be, once again, for individuals, 25%. And if it's shares in a company that you're a substantial owner of, then you would pay an additional 5%. Again, don't forget the surtax, 3% more if you have taxable income in a year of more than 650,000 shekels. And business income. Let's talk a little bit about business income. A little bit more trickier than passive and capital gain. Reason being that when you have a business, you may find yourself actually generating income while you are in Israel. And as we said, the exemption applies only to income that was derived or generated outside of Israel. So in the matter of business, many times people find themselves, especially if they deal as consultants, I know that accountants and attorneys and other consultants that have a personal business find themselves in a position where they spend time both in Israel and abroad. And the question is, how do you tax that? When it's clear that you generate the income both in Israel and outside of Israel. So the Israeli tax authority's position on that was published in a circular number 1 on 2011. And they just took the days in a tax year, divided it into income that is generated while you are outside of Israel physically and while you're in Israel physically. And the time you spend in Israel physically would be taxed in Israel. This, of course, is not always beneficial and not always compatible with what is actually happening with the business. So for instance, in many cases, there are taxpayers who spend an ample amount of time in Israel, but most of that time is during holidays and weekends with time that they want to spend with their families and not necessarily working. And the weekdays are spent outside of Israel and generating the actual income. in those kind of circumstances, and the District Court of Israel has approved that that kind of operation, you may claim, provided of course we recommend having a legal opinion to support it, that despite the fact that you spent a specific amount of time in Israel, you would not necessarily have to pay income tax on that time based on the division between the days. And you may find a different way of dividing the income between your Israeli sourced income and your non-Israeli sourced income. Another issue with regarding business is with regard to companies or corporations. If they are usually, if a company, of course, if it's established or registered in Israel, it would be an Israeli corporation for tax purposes. But also, if a company is registered outside of Israel, it also may be construed as an Israeli tax resident if the control and management of that company is in Israel. There is a specific exemption for new immigrants, for Olim, that if the only reason this company becomes an Israeli resident for tax purposes is because they are the controllers and the managers of the company, then because they are Olim Chadashim, the first 10 years, that company would not be considered an Israeli company for tax purposes. But of course, this is only true if two things apply. One is that this company is not an Israeli company for a different reason, other than the immigrant being the manager of the company. And naturally, of course, if the company generates income in Israel, then despite the fact it may be construed as a foreign company, it still would have to pay taxes in Israel because the income was generated in Israel. So that's with regard to business income. Real estate taxation, we will discuss in brief the purchase tax, but we'll not get into capital gain. Purchase tax in Israel is any time that you purchase land, whether it is residential, vacant land, or commercial, you would pay purchase tax, which will be at a rate that is relative to the value of the sale, or by a fixed amount determined by the type of sale and the type of the real estate. So here is the significant difference between land in Israel with regard to purchase tax is the difference between land and commercial to an apartment. So land and commercial are purchase taxes set on a fixed amount of 6% or 5% in special occasions, and an apartment, which usually is based on tax brackets. And as you can see, this has been actually a pretty new revision. Purchase tax begins on the first bracket at 5% and goes all the way up to 10% if you purchase real estate, residential real estate, at an amount of 17,700,000 shekels or up. If it's a single apartment purchased by an individual Israeli resident, then you could see that the first bracket is 0 and goes again all the way up to 10%. So this is a significant exemption from the regular tax brackets on a regular apartment. But this is only true if this is your first apartment in Israel, and only if you're an individual Israeli resident. So what does that mean? What is an individual Israeli resident? That includes anyone who became an Israeli resident, including an Oleh, within 2 years of the date of purchase of the apartment. So this means that you don't necessarily need to purchase the apartment only upon your arrival. You can prepare ahead of time. You have 2 years to make your immigration consummated and come to Israel, and you will be eligible for the first apartment purchase tax rates. Another way to enjoy purchase tax at a lower rate, and this is only special for new immigrants, for Olim Chadashim, is if you do this within a year before you come to Israel or within 7 years from the time you landed, And then your tax rates would be on the first bracket 0.5%, and anything above 1.8 million shekels would be taxed at a flatted rate of 5%. This is only true, though, if the Oleh Hadash uses the land to build his residential apartment and live in that apartment. So if you don't live in the apartment and you just purchased that apartment for an investment, that may cause the tax authorities to say that you're not eligible for this specific tax exemption. So now we come to trusts. And trust, as I said from the offset, this is a pretty complicated issue. So we'll take it a step at a time. We'll start with definitions, and then we'll enter into specifics of what is an Israeli taxable trust, how can you get away from it, how to avoid accidents. And again, this is a bit complicated, so we'll really try and start from the basics. So here's the basics. And usually in trust, you have 3 players. Sometimes you have less than 3 players if you have a settlor and a beneficiary, or a settlor who's also the trustee. Sometimes you have more than 3 players if you have a protector of the trust. So the settlor is the person who establishes the trust. The beneficiaries are those who receive income in our capital or getting a distribution out of the trust. And then there is the trustee who manages and distributes the funds. A trustee can be an individual, it could be a corporation. And again, as I indicated, the settlor can also be a trustee. Not always favorable, as we can demonstrate shortly, but it is in Israeli law, it is available. You can be both a settlor and a trustee. Being a settlor and a beneficiary is something that is less common in Israel. So tax of trusts is something that actually is quite unique in Israel. Trusts were not taxed or they weren't, the provisions were not set up in law up until the year 2006. And in 2006, first time that was represented provisions of taxing trusts. And in the first time, the first provisions in 2006, there was a special exemption on trusts that were created by settlers who were living outside of Israel, even though there were beneficiaries who were Israeli residents. And it was quite obvious why this came to be. The notion was that a settler who creates a trust outside of Israel, the assets and the income are outside of the Israeli net. So anything that the beneficiary in Israel would receive in that kind of a trust should be tax exempt, as if there was a settler who transferred assets as a gift to the Israeli beneficiary. And just to point out one thing that I haven't mentioned in the slides, since 1981, there is no estate tax or inheritance tax in Israel, and that of course means there is no gift tax. So if you gift someone in Israel, unless of course he is a foreign resident, which means that you're taking an asset outside of the Israeli net, you will not pay taxes upon that transaction. But the Israeli tax authorities have decided to change the rule, the initial rule, that said that a settler, a foreign settler that establishes a foreign trust would not pay taxes even though there are Israeli beneficiaries. That has all been changed in 2014 and for the worse. And since 2014, trusts are subject to reporting obligations and Israeli tax on profit in the following general instances. One is if the settler is an Israeli resident, and the other is that one of the beneficiaries is an Israeli resident. And this is an issue. This is an issue because it means that it's enough that you have one beneficiary of a trust who is an Israeli resident to contaminate the entire trust, to have that trust report and pay taxes on its entire income in Israel. Even though there are beneficiaries who are living outside of Israel, even though there are the Israeli beneficiaries never got any kind of distribution, and the trustee is not willing to distribute to the Israeli beneficiary anything, that would not matter. The law states specifically that once you have an Israeli beneficiary in the trust, you would have to report and pay income tax on the income of the entire trust fund. The third option of having a trust get into the Israeli net, of course, is if there is an asset of the trust that is located in Israel. Now, this is something important. The obligation to report and pay taxes on the trust assets is borne to the trustees of the trust. That means that those who are eligible and liable, not eligible, liable for the reporting and paying of taxes are in general the trustee. However, there are certain occasions, specifically when there is an Israeli beneficiary and the trustee is a foreign resident, that the beneficiaries would find themselves paying the tax instead of the trustee who hasn't paid the tax. So this is a real issue, specifically when we are discussing beneficiaries who became Israeli residents. As a general rule, in most cases, a trust income created by an Oled prior to making Aliyah, and this is important to note this, it has to be before he became an Israeli resident, will be exempt from tax in Israel during the holiday period, the first 10 years of his immigration, provided there are no Israeli beneficiaries and the trusts hold no Israeli assets. Now, when I put a star next to the Israeli beneficiaries, this is of course to exclude any beneficiaries who are also themselves are Olim Chadashim. So if all the beneficiaries, all the players in the trust, the settler and the beneficiaries are all Olim Chadashim, then for the first 10 years, that trust would be tax exempt in Israel. Let's discuss a settler who made Aliyah. So a settler who made Aliyah, once he comes to Israel, then excluding the first 10 years, that as we mentioned, will be tax exempt. After the 10 years, the trust becomes an Israeli taxable trust. And what happens though if a settler has established a trust and has foreign beneficiaries and the entire trust fund is compiled of assets that are located outside of Israel? The tax authorities understand that in that specific situation, the trust has never entered the Israeli tax net. But that is only provided if two things apply. One is that the trust is an irrevocable trust. And we'll discuss shortly what does that mean. It doesn't mean what you think it means, all right? The word irrevocable trust, when you think about that term, you think, all right, that means that the settler is not allowed to give any kind of instructions to the trustee, and that's that. Well, in accordance to the Israeli tax ordinance, it's not only that he is not allowed to give instructions to the trustee or to get the funds back to him, and shortly we will discuss exactly what that entails. And the other thing that he has to have in that kind of a trust, if he wants to keep it outside the Israeli net, is that all the beneficiaries during the examined tax year are foreign residents and can be identified separately. That means not necessarily that you need to demonstrate that the beneficiary is living at the time. It could also be an unborn beneficiary, but it has to be designated beneficiaries and not something amorphic that you cannot know if that beneficiary has become an Israeli resident for any reason. Naturally, if you do enter into that regime, then the trust will be outside the Israeli tax net. You will not have to pay or report any kind of income of the trust, provided, of course, that if you do put any kind of asset into that trust during the time you're an Israeli resident, that, of course, will constitute a sale because you took an asset and took it out of the Israeli net into the trust, which is outside the Israeli. And usually in trusts, other than this specific foreign beneficial trust, when you invest asset or funds into a trust, it will not be a taxable event. So in this specific case, because the trust is outside the Israeli net, the investment of an asset into that trust would be taxed in Israel. So what is an irrevocable trust? An irrevocable trust is defined as follows. One, that it is not a revocable trust. And that is actually the real issue. It looks very, very simple, but that's the real issue. And secondly, that the trustee and the settlor declared in an affidavit to the Israeli tax authorities that the trust is an irrevocable trust. So what is a revocable trust? We want to know how to avoid being recognized as a revocable trust so that we can enjoy the special treatment of a foreign beneficial trust. So there's a list of 10 different types of trusts or events or circumstances that would be construed as revocable trusts. One is that it holds an option to revoke the trust. The settlor has an option to revoke the trust, or its assets or funds can be transferred or returned to the settlor or to his spouse. Two, one of the beneficiaries or his or her spouse is the settlor of the trust. Three, one of the beneficiaries is the settlor's minor child, or if it is possible to transfer an asset or income to such a child while the settlor or his spouse is still alive. And that is not always easy, because sometimes you build up the trust in a manner in which if you pass away and your spouse is now still alive, if you have minor children who are the beneficiaries, that would be a revocable trust, and you will not be entitled to receive the benefits of an irrevocable trust. Four, one of the beneficiaries is a corporation in which the settlor or his spouse or a minor child of his holds 10% or more of the controlling means in the corporation, which is, in short, we would describe it as a held corporation. Five, the trustee or the protector of the trust is a settlor or held corporation. Six, if the trustee or the protector of the trust are close relatives of the settlor, unless the tax assessor is satisfied that the settlor does not control the trust. Now, in many cases, the parents or those the settlers who create the trust want to be sure that the trust is either protected by a close relative of theirs or that the trustee himself is a close relative of theirs. So this is something that the tax authorities realize may be possible in many circumstances. So they do allow for that to happen and still have the trust be determined as an irrevocable, but you would have the burden of proof on you to persuade the tax assessor that that was something that does not give actual control to the settlor. Seventh circumstance is if the settlor or his close relative have the ability to control the trustee's actions. Number 8 is one of the beneficiaries is unidentified unless it was proven that he or she is not the settlor's spouse, minor child, or held corporation. Ninth circumstance is that the trust beneficiaries have been replaced by other beneficiaries or new beneficiaries were added without the trust declaration having supporting language to do so. And the 10th circumstance of becoming a revocable trust is that the trust was not declared an irrevocable trust in due course. So naturally, this means that you must be prepared before you actually make the aliyah. And if you want this to become an irrevocable trust, you need to make absolutely sure that this trust would not fall into one of those 10 circumstances. So that was with regard to a settlor who made aliyah. But what about a beneficiary? And that, as I said, can be a real problem if this is one beneficiary out of a number of beneficiaries who becomes an Israeli resident, and therefore by that contaminates the entire trust and makes it into an Israeli taxable and reportable trust. So course, for the first 10 years, if he makes Aliyah, the first 10 years, even though he is a beneficiary who lives in Israel and is a resident of Israel, he will not be subject to reporting or to tax in Israel. But the trust will be exempt from tax payment for the duration of the holiday period, as long as there is no other Israeli beneficiary who is not an Oleh Chadash. And naturally, after the end of the 10-year term, it becomes taxable in Israel. So what really happens if you are one beneficiary who is a beneficiary of a trust, you have siblings, let's say, who are still remaining in the country of origin and are not making Aliyah, and you know that after 10 years, that trust would become taxable and reportable in Israel on the entire income of the trust. So just in short, we gave 3 exits. Not all are the best approaches, not all are optimal, but those are what we believe to be the best approaches there are. And I'll actually start from the end. Exiting the trust, if possible, is something that should be considered. Naturally, of course, you need to take into consideration tax issues in the country of origin, and of course, the ability of the beneficiary to decide that he is leaving the trust. Usually beneficiaries not always have that ability. So this is something that should be discussed with the settlor of the trust. The designated solution, I'm going to the top, is something that should be considered, but that would apply only for irrevocable trusts, and we just demonstrated how difficult that could be, and only if dividing the trust funds by designating an exact portion to each beneficiary. So if you're able, as a settler, to have the trust determine specifically what will be the share of each beneficiary, and you're able to avoid the circumstances of being a revocable trust, this is a solution that could actually work. Because what a designated trust actually does, it designates between beneficiaries. And if there are foreign beneficiaries in a designated trust, they would be treated as foreign beneficiaries, and their share in the trust would not be taxable in Israel, unless, of course, their income was generated in Israel, which is usually not the case. And the third option would be to divide the trust so that the Israeli beneficiary would be the only beneficiary in the trust, which again is something that you should plan ahead of time and not start doing that after you made Aliyah, after you became an Oleh, and you're waiting for the 10 years to elapse. A lot of things can happen during that time. One thing that should be noted is with regard to reporting the trust. Reporting means 2 things. One is to declaring the existence of the trust, and the other is, of course, filing tax returns on an annual basis. In those 2 circumstances, we have an issue in which, on one hand, as an Oleh Chadash, you're exempt from reporting anything you have outside of Israel, as I have indicated. However, with regard to trusts, it is not crystal clear by the language of the law that you are exempt from reporting the trust or declaring it while coming into Israel. So in those circumstances, we do recommend seeking a legal opinion with respect to the application of the holiday period on declarations and on the annual reporting obligations of the trust. I think we made it. And now we have, I think, approximately 5-10 minutes. If any one of you have any question, you can send them through the Q&A, and we'll be happy to answer.
Thanks, Paul. I'm just going to add one thing that I wrote down a couple of questions people asked. I'm sure a few more will trickle in in a few minutes. But really just to reiterate, I think the last thing that Boaz said, which is I think he did a really good job giving an overall summary of the 2 main issues as far as center of life and trusts. And he summarized things really well. But at the end of the day, I would always suggest, as clear as the presentation is, you really do need to speak with a professional. Every case is very different. Some of the questions people ask are very specific. I tried to answer them a little bit, but ultimately, here's our contact information. Please, be in touch with your specific questions when the time is right, and we'd be happy to help. Boz, I wrote down one specific question that somebody asked, but I think it was a handful of other questions along this route. This deals with U.S. pensions or really any foreign pension. The specific question was distribution from my 401k after the 10-year span. I already pay tax to the United States. How is Israel going to treat the tax I already paid to the United States?
Right. So we're discussing an IRA that was the money was invested by you when you were employed.
Yeah, everything was earned in the U.S., retired in Israel, and then took a
Right.
distribution after the 10 years from the IRA. Yes.
Right. So if it's your IRA, if it's not an inherited IRA, so as I've indicated, you have the same tax treatment as if you would have remained in the United States. And if you remained in the United States and you wouldn't have paid any more taxes other than those you already paid, that means that Israel will not tax you, just as if the United States wouldn't have taxed you. So that's the answer.
Great. Then, let's see, I guess you can see the questions that came in also.
Sure.
See if there's any ones that jump out at you that you'd like to answer. Let me see if I wrote down. I think that a few of these questions have already kind of been answered, and
Sure. I think so.
Here's one question we got that's about purchase tax,
Sure.
which is as a foreigner who already owns one apartment in Israel, is there a larger purchase tax on the second apartment? And can I become an Ola Chadash and get a lower rate even if I already own one apartment?
Right. So yeah, right. So and that's a very good question, and I actually did not address this issue. So the special purchase tax rate on new immigrants, as opposed to the first apartment purchase tax, is something that you can use even though it's not your first apartment. So you can enjoy these special rates of 0.5% between 0 to 1.8 million shekels and 5% on 1.8 and above, even though it will not be your first apartment. It could be your second or third or fourth apartment, but only provided that two things happen. One is that you purchased the apartment a year before you made Aliyah and up to 7 years from the time you made Aliyah. And the second rule is that you have to live in the apartment. It has to be your residential address. It has to be the place you dwell. There was an interesting district court decision regarding two people who made Aliyah, a couple who made Aliyah from Europe, and they went through the procedure, got their Teudat Zehut, their Israeli passport, and they purchased a small condominium. The thing was, though, that they spent only 60 days in Israel. So, and they claim that every time they come to Israel for those 60 days, they are using that apartment as their residential apartment. And therefore, they are entitled to the special Olim tax exemption on the purchase tax. And the district court decided that they're not entitled to that because living 60 days in Israel means that they're actually not living in Israel. So if you're planning to make the technical Aliyah procedure and purchase a residential apartment only to live in Israel for a short period of time of no more than 2 months a year, you will not be eligible for the special purchase tax for Olim.
Okay, great. So I think the last question we're going to ask, and then what I always suggest to people is, well, me and Boaz, as well as Boaz's colleagues, will stick around for another 10, 15 minutes or so. If you can keep typing in questions, we'll type and respond, but we'll end the recording, we'll end the formal presentation But Boaz, I think the last question was slightly changed what the question says, but we're going to say, how is U.S. really any? How is foreign earned rental income treated in Israel after the 10 years?
Right.
Also, the same depreciation expensing apply to Israel as you get in the U.S. And is there a optimal way to structure U.S. rental real estate to help you with the earlier two questions?
Right. So you can also elect, and usually it's not preferable. In the United States, I think it's not preferable at all. You can elect to be taxed at a 15% tax rate on the gross income of rental income that was generated outside of Israel. But that is only provided that you are not entitled to receive an exemption or any kind of tax credit that was paid in the country of the real estate. So if it's not the 15%, it will be marginal tax rate. Usually what Israelis do, and it's not always beneficial because they are not always aware of the estate tax in Israel, but if you're a US citizen, it's not an issue. Usually they would use an LLC. That would be the owner of a real estate in the United States and will have the LLC elected to be transparent for tax purposes. So again, that would mean at the end of the day that you would pay marginal tax rate on the rental income. You would, of course, be entitled to receive the tax credit that is paid in the United States and any expense that you paid, including appreciation of the land, are, of course, calculated into the taxable income.
Okay, great. So thank you very much. I think this is the formal end of the presentation. Again, you can feel free to spend another 5 minutes or so asking a few questions via the live chat. And then whatever we don't get to, again, you feel free to email myself or Boaz with any questions you have. And thank you, Boaz, for the presentation. Thank you, Nefesh.
Thank you, Eli. Thank you for all the participants.
Thank you. Thank you again. Again, this is Josh Sussman from Nefesh B'Nefesh. We will be sharing the recording and the presentation by email in the next day or two. I am going to stop the recording now. Thank you very much for being with us, but we will continue live with Eli and Boaz taking any additional questions. Thank you very much for being with us.